Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right. During the current downtrend, there's been periods where the dollar is sold off, and I know everybody's probably wondered how much lower can it go. We're going to talk about that in a little bit here, but during these periods, prices actually start to go sideways again. The market starts to move back into balance. The buyers and sellers are just about equal. There's a lot of short covering in this recent dollar downtrend, and that can go on for many, many weeks. This is the intermediate term trend, which is counter to the primary trend. And again, some of the currency pairs, it's been lasting for several weeks or several months. Now, obviously, you get a pair like the Australian dollar, the dollar versus the Australian dollar. Interest rate differentials are going to drive that trade. And of course, currency traders are going to see right away that, well, listen, if I can go ahead and borrow dollars at next to zero and I can invest them in Australia at 3.25, they just recently raised interest rates, I could take advantage of the leveraged interest rate trade, which we call the carry trade. And years ago, of course, that was more like a 7% trade, maybe 6.75% after fees. Of course, now it's around 3%. So it's still a good deal. And that's one of the reasons why the dollar has been persistently trending lower against the higher yielding currencies like the Australian and the New Zealand. Okay. Other pairs have gone sideways because they're funding currencies pretty much like we are in the carry trade, as the yen has been. But not all of the currencies are going to go sideways for periods of time. Mostly the economies that are pretty much linked, like the Canadian economy and our economy, which are pretty much linked by economic factors, have been the ones that have gone sideways the most. So those are the ones that we're really going to focus on when we get to our presentation. So this is a chart, a 4-hour chart of the dollar versus the Australian dollar. We have been trading in trading ranges. This is, again, 4 hours. So this is more like an intermediate term trend, an intraday trend. And this, again, you can see longer periods of time on this chart. But you can also see at certain periods where you have little profit-taking retracements for a few weeks or months. And not only do you have that, but you have, you'll have sometimes here, I'll just point one of these out with the pencil. Here you have a little retracement here. Here you have some sideways trading. And then all of a sudden you break out to the downside. You don't go very far, but then you begin another period of sideways basing. Okay, and then again, of course, that breaks out to the downside, and the downtrend has been continuing. But the overall trend, this one trend line that I drew here on the chart, hasn't really moved. And so this one here is not really going to be the best currency pair for sideways trading. Okay. Remember, we talked about, and we'll get to these slides in a minute here, we talked about how the market kind of moves in the 4 kind of stages along with the economy. You could see them on these charts, 4-hour charts. You're really just taking an x-ray of your daily charts. You're actually taking an x-ray of your higher time frame charts. And you could see how we had this little basing period last year before we broke out into a strong uptrend when all the financial chaos was going on here. It was almost straight up. And then we actually topped out at around 163 to 165, and we had our first sell-off right here. And this is, again, usually where an intraday trader or an intermediate term trader, or even somebody that's trading the primary trend, can kind of get a heads up that there's resistance that has to be absorbed, and that was your first opportunity right there for shorting a rally in a brand new downtrend. And of course, once we broke these lows here, which when you see the higher time frame charts, this was very, very important support, we just about completed the entire 4-stage cycle. Stage 1 accumulation, Stage 2 uptrend. We had a nice big Stage 3 top, a lot of volatility here, and then we had a Stage 4 decline, which is very close to completing the entire cycle. So these patterns here are what we call trend continuation patterns, basing and breaking out to the downside. So it's important that you understand that. And as long as you understand that and you realize that if you do trade in a trading range, there's the possibility you could break out to either side, we have strategies in the options that you can use to do that. This is the Canadian dollar. Once again, we had this intermediate term counter trend rally that was pretty nice. We rallied into some resistance here, and then we went sideways here for many, many months in another sideways channel starting in August. And we pretty much stayed in that channel and eventually broke out and made new lows. But during this entire period, if we can identify these areas where prices have turned in the past as support and resistance, which we'll talk about in a little bit here, this is the opportunity for us to identify these potential trading ranges and then devise strategies for how to take advantage of this. So support, again, is created in the past where buyers have come into the market and caused prices to turn higher. A lot of times what people don't realize is if a buyer was successful buying a stock at $50, for example, and the stock rallies up to 65 and he sells that stock, he's going to remember the last time he bought the stock at $50. He's going to say to himself, you know, the last time price traded at $50, I made some money here, so maybe I want to rebuy that stock if it revisits the area where he had the successful trade. How about the guy who was on the other side of his trade who short the stock? How about he's just insisted the stock's not worth 50, it's only worth 25, he's going to sell it short. The stock goes up to 75 and he's sitting there sweating. All of a sudden the stock starts to come back down to the place where he actually opened his short position. He may decide to cover his short position, which again is buying, which adds additional buying pressure. And resistance, of course, is just the opposite. It's places in the past where sellers have come into the market, they felt that prices were overvalued, they sold, and there were not enough buyers to absorb the sellers, and prices turned and went lower. And so again, if sellers were successful, and you'll see this happen all the time, there's big levels in the currency markets, there's big levels in the equities markets, there's big levels in the index futures markets where prices will stop almost magically and spend quite a bit of time rotating. And if the buyers end up winning the battle, of course, absorbing all the supply at that area, prices will end up rallying higher in search of more sell orders. However, if the sellers win the battle, then prices will turn lower. And of course, the guy who bought that high price, if price ever does rally back up there, the first thing he'll say is, I'm going to get out of this trade because I was wrong. And he'll put additional selling pressure into the market. However, psychologically, what he'll say is, and this is what people do, they'll say, it came back to the place where I bought it at, so I'll get out of this trade, not because I was wrong, but because because I got a chance to get out even. So by getting out even, I don't have to admit I'm wrong. So that's the psychological thing. Again, that's where people get trapped. They get out at close to where they got back in instead of admitting that they made a mistake in the first place and taking a small loss. They sell at break even, and that way they don't have to admit they were a loser on the trade.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.